Okay, good afternoon, ladies and gentlemen. Welcome to the indexuniverse.eu webinar, ETF Risks, Real or Exaggerated. This webinar is sponsored by SPDR, ETFs Europe, State Street Global Advisors, and will run for the next hour. My name is Paul Amery. I'm the editor of indexuniverse.eu and the Journal of Indexes Europe. I'm joined today by Eleanor Hope-Bell, who's head of Northern Europe at SPDR ETFs, Bert Verdoodt, who's a senior associate at Clifford, a legal firm specializing in banking and finance law, and by Mirzha Manuel, who is a researcher at Brussels-based Center for European Policy Studies, and Mirzha specializes in the area of asset management regulation. A reminder for anyone listening, for all of you listening in, that it's easy to submit a question. Please do so at any time during the next 60 minutes. We'll be moving on to a question and answer session at about 2:30 UK time, 3:30 European time. To enter a question, you just have to click on the question mark icon on the floating toolbar. If your Q&A window is not already open in the lower right-hand corner of your screen, you type your question into the small dialog box and press send, and I will then moderate the Q&A session and pass your questions on to the panelists during the second half of the webinar. This is the agenda for today's webinar. We're focusing on ETF-specific risks, and risk is obviously a key concern for anybody investing at the moment. It's probably been of increasing importance throughout 2011. Now, anyone investing will know that if you don't take risk, you don't earn any returns. So I think it's important above all to put risks into context. But if I could summarize what we're trying to cover in the next hour, I think we're not talking about let's say, to use Donald Rumsfeld's phrase, the known unknowns. So we're not talking about market risks in general and what you'd expect to be exposed to when buying a particular asset class, whether equities or fixed income or currencies or commodities, but maybe some of the, if not unknown unknowns, or maybe then less well-known unknowns. So in other words, the things that you might not quite expect to come across, but which could still affect you if you're unaware of them. So the purpose of the webinar is really to uncover, for those who are unfamiliar with the particular risks, some of the areas that have been of concern in debates over ETFs this year, and to try above all to put things into context. We're also going to look at the regulatory debate that's going on, and in particular the important discussion and consultation paper that's going on at ESMA, the European Securities Market Regulator, because that will affect the way the ETF market in Europe operates in coming months. And after around 30:30, we'll move on to a question and answer session where you'll be able to put your questions to the individual panelists. Before we move on to the individual risk sections, I'd just like to recap the different warnings we've had from global regulators about the ETF market over the last couple of years. And there have been, as you can see from this slide, there's been a long list of regulators' comments, interventions, discussion papers, initially from regulators in the US and Hong Kong and the UK, but then from spring this year by a number of global regulators, including the G20 Financial Stability Board, the IMF, the Bank for International Settlements. And we've summarized the areas they focused on. As you can see, there's a very wide range of ETF-related warnings or concerns that they've raised. And we're going to cover the most important of them in this seminar, and to try and answer the question, why have ETFs drawn these particular questions from regulators? Let's start with perhaps the major potential concern of investors, and something that's come up a lot in the ETF debate over the last couple of years, although I'd like to stress that some of these questions are not unique to ETFs, and we'll return to that point later. But what are we talking about when we say counterparty risk and collateral? Well, the definition of counterparty risk is the risk to investors that a counterparty or a third party involved in a financial relationship fails to meet its contractual obligations, and in the context of ETFs or funds in general, with a financial impact on the fund and the end investor. The counterparty risk can be and is offset or mitigated, to use a legal term, by the use of collateral, in other words, some form of protection for investors in case things go wrong. And this exists in all these types of risks. I'm talking about a European UCITS framework here specifically, but also this also applies to other funds. Any funds using derivatives or lending securities may incur some of these risks. You'll see that in a synthetically replicated ETF on the left-hand side of the chart, the page, when there's a counterparty transacting with the ETF via a swap or a derivatives contract, that creates some counterparty risk. If the ETF is lending securities to a counterparty and taking collateral in return, there's also some counterparty risk being incurred. And we'll look at how that occurs and what can be done to offset it. Let's look at, first of all, at synthetic ETFs or swap-based ETFs. There are two prevalent models in use in Europe, and some funds fall into the first category, some into the second. Some issuers have both, so it's important to check what type of ETF you're using or considering using when it's a synthetic one. The difference really relates to the way that the assets are held in one case and what the assets are in the other case. Let me explain. So in the unfunded swap ETF structure, the ETF sponsor gives cash to the swap counterparties and is effectively given a basket of stocks in return, which may be unrelated to the index being tracked. But the ETF and the ETF sponsor acting for it effectively owns that basket of stocks, and then via the swap, the return on the basket is swapped for the return on the index. So it's the swap counterparty or counterparties, usually a bank, that guarantee the index return to the ETF. In the funded swap model, what happens is that the ETF and the ETF sponsor give cash to the counterparty, but effectively receive a promise of the index return from that counterparty, and the promise is backed by collateral, usually in the form of a pledge to an account at a third-party custodian and a pledge of collateral. And the differences in this structure we'll turn to on the next slide. So the key points I think to be aware of are that the unfunded swap ETF owns the assets, or sometimes called the substitute basket, and then swaps that portfolio's return with a counterparty via a derivative contract. The funded swap ETF, by contrast, owns a receivable from the derivatives counterparty and is pledged collateral from that counterparty. So there's a difference there. In the first case, you've got ownership. In the second case, you have a pledge of assets. Now, some of these pledge of collateral, rather. Some of these structures, the funded swap structures, can differ, and it's important to look at how the legal terms work in each particular case. Now, in both types of fund, there is a counterparty limit which limits exposure to any single financial institution, and that is 5% for a non-EU firm or 10% for a European Union financial counterparty, and that's a limit per counterparty. Now, in practice, in both types of ETF structure, any uncollateralized exposure is now very, very small. In other words, you don't get anywhere near that 10% limit. Most ETF providers now reduce the exposure to zero, or even over-collateralize the exposure. In other words, give more collateral than the underlying mark-to-market value of the swap. It's worth being aware that the swap reset rules, how frequently the swap gets reset if as a result of market movements, can vary from one fund to another. So that's an important thing to look at. Funded swap ETFs, those giving a pledge of collateral, often over-collateralize, and that's usually because regulators impose so-called haircuts on equity collateral. In other words, they specify a level of over-collateralization when collateral is posted. In other words, you'll see that when the funded swap ETF exists, you may find that the collateral exceeds the value of the assets of the fund by 120, 125% in some cases. Let's turn to securities lending, which also creates counterparty and collateral exposures. Securities lending can be used by funds, including ETFs, to offset fees. It's a popular thing for ETF managers to do, not least because ETFs tend to have a fairly static portfolio of holdings. They're passively managed funds, so the constituents the index constituents don't change that much, so there's less of a likelihood that the fund manager moves assets around. So they offer ideal lending vehicles, but it's important to note that the managers of the fund may be incentivized to lend via so-called fee split. In other words, they can retain some of the lending fees for themselves, pass a proportion back to the fund, while the fund investor, in the prospectus, if you read the language closely, will bear the risks of something going wrong. Now, it's important to note that not all physically backed ETFs, in other words, those that start by owning the index securities, do lend their stock out, but at the same time, under the current UCITS rules, up to 100% of fund assets may be lent. If you look at what funds lend in practice, I know that some fund managers, some ETF fund managers now provide increasing amount of information on this. You'll see that some tend to lend a lot, others may lend on average only a few percent a year, and some don't lend at all. So that's certainly worth being aware of. There may be additional protections for the investor. In some cases, ETF issuers offer a default indemnification, which is a form of insurance to the ETF issuer, and so there's an additional form of backing given to the ETF investor in case the counterparty defaults, the collateral is insufficient to cover the cost of buying back the securities that have been lent out, and so the bank, usually the bank owning or related to the fund, or a bank or the fund manager itself, can offer some indemnification to cover the risk of losses, and that's obviously, as any form of insurance, not free. So that's worth also taking into consideration when you're assessing whether, as an investor, you're getting a good deal when lending takes place. Here we've identified some differences in lending practices between the US and Europe when it comes to regulated funds. I think the key, as far as collateral is concerned and collateral exposures, there's not a great deal of difference, even though the rules are in Europe are set by individual country. I think one key thing to focus on here is that in the US, regulated funds or 1940 Act funds may not lend out more than a third of their total assets, whereas under UCITS, it's currently possible for funds to lend out up to 100% of their assets. At this point, it's probably worth mentioning that ESMA, the European Securities Regulator, as one of the points in its discussion paper, did suggest the possibility of bringing that limit down from 100% for UCITS funds. And on fees, in the US, there has been historically a requirement to obtain approval from the regulator before using a related party as your lending agent. In other words, using another part of your financial institution to work as the lending agent and take part of the fee split. There's an obvious potential conflict of interest there. But at the same time, as far as I'm aware, that this has historically been treated, or let me put it this way, it's not been common for the SEC to refuse such requests, as far as I can establish from what I've read. In Europe, by contrast, this again depends on the individual EU member states. I think it's quite likely, and I'd like to hear the panelists' expert views on this, that we will see some changes in lending rules as part of the current ESMA consultation. Now, when both derivatives are involved or securities lending, collateral is used to give the investor in a fund some protection. And what are the key points to note when it comes to collateral? Well, I think the most important thing to keep an eye on is the potential mismatch between the index basket, in other words, what your fund is tracking, and the collateral that's being given instead. Whether that's in a physical ETF lending stock or in a synthetic ETF where you have counterparty exposure automatically. And this is something that regulators have made clear in their comments, and we've seen the firms within the ETF industry really confirming it in some of their responses to the ESMA discussion paper. If the collateral given to the fund is of lower quality than what's in the index, there's effectively an economic benefit being given to the counterparty at the expense of the fund and the fund investor. And this is commonly referred to, well, it depends which way you look at it. It could be a collateral upgrade trade or a collateral downgrade trade, depending on how you're looking at it. And so the closer the collateral makeup is in quality and type of instrument to the index being tracked, the less scope there is for any such collateral upgrade or downgrade. The further it is away, the more potential economic benefit there is to the counterparty. As far as collateral is concerned in general, it's important to beware so-called wrong way risk. In other words, when your collateral is actually correlated in behavior to the counterparty itself. And an example would be taking collateral from a bank in a country that's perceived as a credit risk, or that bank is perceived as a credit risk, and the collateral you're taking is in the form of, let's say, bank shares from the same country. That would be an example of wrong way risk, where if something goes wrong with your counterparty, your collateral may end up being as worth less than you would have wanted. Correlation and diversification of collateral to the fund are also important. And how transparent is your ETF's collateral? Well, we've seen it in synthetic ETFs. We've seen, I think, almost all issuers now moving to publish the collateral backing or the assets of their fund, in the case of the substitute basket, on their funds on a daily basis. We're starting to see some similar moves amongst providers of physical ETFs when they lend securities. Above all, when considering counterparty and collateral risks, I think the main question to concern yourself with is, who's my counterparty? And someone said at the conference I went to last week on this subject, it's better to take lower quality collateral from a good counterparty than top-rated collateral from a bad counterparty. In other words, it's the counterparty question that's more important than the collateral question. Very important, I think, to stress that counterparty risks are not unique to ETFs. Any UCITS or any fund using derivatives is going to be doing the same things and exposing investors to the same types of risk. Other financial savings products like notes, certificates, bank structured products could give you full counterparty risk with no collateral cover, so you're fully unprotected. And I'm afraid to say, in the current environment, even bank deposits above insured limits, and then even government debt in some markets are clearly not risk-free. So it's important to try and put these, even though it's difficult to do so, it's important to put these risk concerns into some kind of context. And clearly safe haven concerns now extend far beyond ETFs. And making it more difficult for all of us, the pool of acceptable counterparties has been shrinking. As you can see from this slide, this is the Markets iTraxx Europe Senior and Subordinated Financials Indices. In other words, indices of credit default swaps, or indices effectively showing the cost of insurance against default on banks' senior unsecured debt, which is the blue line, and subordinated unsecured debt, the red line. And as you can see, after a spike in 2008 and 2009, these indices fell back, but now they've moved to all-time highs. So based upon these measures, we've got higher levels of counterparty risk than at any time in the last 5 years, and probably going back much longer before these indices existed. This is a real concern, and it goes far beyond the ETF market. Let's move away from counterparty and collateral exposure to other types of risk. This is an ETF-specific one. It's certainly on a smaller scale, but it's an important one all the same. Tracking risk where the ETF performance may not match that of the benchmark. I think it's important to distinguish between tracking difference and tracking error. Tracking difference is usually measured or taken as the difference, absolute difference in return over time between a fund and its index. Tracking error is a measure of variability of return on a day-to-day basis or on a periodic basis. Sometimes measures of tracking errors or tracking differences may not be real. There can be timing differences between the valuation of the index and the valuation of the fund that can appear to cause a premium or discount, which doesn't really occur in practice. There can clearly be data errors, but there are some causes of real tracking differences. First of all is fees, which I've forgotten to mention. The fund fee causes a tracking difference between fund and index, but also things like cash drag if the fund has an uninvested cash element, which can work in both ways. Taxes either on the index or on the ETF. Lending revenues can reduce tracking difference. Swap costs may be factored into the ETF return, and in some cases into the index return as well. And when sampling is involved in trickier to replicate indices by physical ETFs, that clearly can lead to some divergence of return between fund and index. It's important to mention that in synthetic ETFs, there is some trade-off between tracking risk and counterparty risk. So there's no free lunch. In other words, if you're getting better tracking ability from the fund because it's the return is guaranteed by a counterparty. Well, that doesn't come for free. This is a chart we used in an article a few months ago, but it just gives an idea of how. If you look at the left-hand scale, these are percentage points over the period of a year and a half. So these are not huge figures, but at the same time, for funds that are supposedly tracking the index, there's quite a surprising variety of returns between different ETF issuers in Europe tracking the same Eurostoxx 50 index. The x-axis shows is effectively the net total return index from stocks. The bright red line at the top is the gross total return, and the difference between the gross return and the x-axis is effectively the tax that's deducted from the net index to reflect dividend withholding taxes. As you can see from the chart, the individual fund returns can be either between the net and total return indices, or in some cases below the net, because issuers do different things with their, can do different things with tax reinvestment. Some get better tax rates than others. But so, don't automatically assume that tracking is the same from different ETFs, just because they are based upon this or following the same index. Liquidity risk is an important one for any ETF investor to be aware of. Trading costs can be an important percentage of the total cost of ownership. Bid-offer spreads can widen do widen during market volatility, as we've seen over the last few months. You can have premiums or discounts to NAV, sometimes reflecting real underlying costs. If you can trade the fund at NAV, you may be able to avoid some of these costs, but there you obviously give up the ability to time your trade. The size of the fund and also the listing of the fund that you're trading may affect the liquidity of the ETF. This is an example of how ownership costs can be, the liquidity component of total ownership costs can be much more important for some funds than the actual fund fee. We've taken some figures from the London Stock Exchange using time-weighted bid-offer spreads for the first 3 quarters of this year. These funds were taken at random, but we've illustrated some with lower dealing spreads and some with higher. And assuming that you buy and sell the ETF at that average bid-offer spread once do one round trip in that 9-month period, your trading costs can be substantially more than the total expense ratio when prorated over that 9-month period. So liquidity is a very important consideration for any ETF investor. Let's turn to indices. These I've always found rather complicated to understand, so I hope I can explain them adequately. But the standard diversification rule for UCITS is the 5-10-40 rule, which means that you can have a maximum investment in a single security of 10%, and all the investments that are between 5 and 10% can add up to 40% total as a maximum limit. In other words, you can't go more than 40% in those names of between 5 and 10%. Now, for index tracking funds, those rules are relaxed so you can have an individual index constituent that can go up to 35% in practice. It's called 20-35, but in practice 35 is the upper limit for most funds under certain conditions. And these are the rules that must be followed by physical ETFs tracking indices in Europe. But if you're using derivatives to track a financial index, or a so-called financial index of eligible assets, you can use what's called a look-through approach, where you can consolidate the index constituents with the assets held directly by the ETF. And this refers to the substitute basket that the ETF is holding. I talked about this earlier in the synthetic ETF section. And after consolidating, you then must comply with the 5-10-40 rules. So in practice, what this means is that you can have, in certain cases, some derivatives-based ETFs that have higher concentrations than 20 to 35 to be tracked by UCITS ETFs. So you've got potential concentration there. This is to do with index diversification, but it's worth being aware of. There are a couple of index-related return factors that can influence people that I don't want to spend too long on. I think leveraged and inverse ETFs are fairly well understood now, and where there's a path dependency of return. I've given an example here showing how the higher the leverage and the higher the index volatility, the greater the difference can be over time between what a simple multiple of the or the equivalent multiple of the index return would be and what the ETF is actually doing. And on this next slide, I've pointed out that in other indices you may get slightly different returns than what you might have expected. In the case of commodities and other ETFs tracking futures such as volatility indices, the shape of the futures curve influences what you receive as an investor. There are also some unavoidable index costs in the form of turnover, but there may be some embedded costs that you need to keep an eye out for in terms of charges, financing costs, spreads, fund-of-fund fees. Custody is the final risk subject I'd like to touch upon briefly. Now that for the ETF, as any other fund, is exposed to custodial risk for the portion of its fund that is uninvested and left in cash. Now for the average ETF, this should be a very small amount because ETFs don't tend to run large cash balances by comparison with mutual funds. But it's worth pointing out that when a fund is physically replicated, I've taken an example from an iShares perspective, there are some potential exposures to sub-custodians. Now this is an area where there's currently a lot of debate ongoing, and specifically whether depositories or custodians, I don't know if I'm correct in conflating those terms, but whether the central depository could be made liable in Europe for the funds they administer. In other words, whether this liability for sub-custodians could be kept by the depository, and obviously if that is the case, it may result in some increased cost to investors. This is something we can touch on in the Q&A. Finally, before passing over to the Q&A, I'd just like to try and put ETFs in context. UCITS funds as a whole currently total around 5.5 trillion euros. Of that total, less than 5%, about 240 billion euros, is in exchange-traded funds. But in fact, nearly half, taking lending as an example of an activity that can create, or does rather create, some counterparty and counterparty risks and collateral exposures, nearly half of all UCITS are approved for lending. And we often hear about counterparty and collateral risks in the context of ETFs, but it should also be applied to that 2.7 or 2.8 trillion of UCITS that include ETFs, but ETFs are a small component of that total. And of course, many non-ETF UCITS also use derivatives. So absolute return fund ETFs, absolute return UCITS have been a very popular segment of the funds industry. They've grown a lot since the financial crisis. They now have over 100 billion euros in assets, according to the latest estimate. That's approaching half the size of the ETF market. All those funds will be using derivatives, incurring counterparty risks. What collateral do they hold? How do they monitor risks? Do they disclose it on their fund websites? I think if you look at some of those fund management houses, you'll find that there's no information or very limited information on their websites. So ETFs have been the focus of attention when it comes to some of these questions, but they're by no means I think they should certainly not be treated as the only cause for potential concern. And I think it's important that where there's a holistic approach taken to, if regulators want to change things, then they hopefully will do it across the funds industry and not focus just on ETFs. Before finishing, just a reminder of where we are with ESMA. Now, ESMA, the European Securities Regulator, published this discussion paper on ETFs in July. There's some of the things they suggested changing, although we haven't heard whether these will be in the draft guidelines. They're talking about a possible restriction on sales of so-called complex funds to retail, although they haven't defined what they mean by complex funds. They're talking about the possible implementation of new naming rules for ETFs to try and distinguish between different types of fund. Again, they haven't yet given guidance on how they might want to do that, although I think the guidelines are to be issued shortly. They've also talked, as far as collateral and counterparty exposures are concerned, they've talked about getting the collateral used when derivatives are involved to match the index more closely, and also imposing some diversification rules on collateral exposures. And they're suggesting to standardize collateral rules across derivatives and securities lending activities, which to me seems to make sense. As I mentioned earlier, there's a possible, they might bring down the lending limit when UCITS assets are lent out. And another issue which they've talked about is for to give individual investors the right to request direct redemption from the ETF rather than as currently having that the right only of authorized participants. So ESMA's, the next steps in the ESMA consultation were due the guidelines to be, according to one press release I saw this week, they're due out very soon. There will then follow a 2-month consultation period, then a further 3 months for the regulator to issue its final guidelines, and after then market participants have a further 2 months to comply or explain with the rules. I'm not quite sure what happens if they decide they don't want to comply, but perhaps I'm sure our lawyers can explain what that means. So to summarize, I guess from an index universe perspective, this is my personal view. My colleagues don't always agree with me on some of these questions. I think the regulators have highlighted some valid concerns. Their risk warnings have been very varied in nature, and many of them are not ETF specific. I think it's clear from, if you read the BIS and FSB papers, they're worried about the involvement of banks in the ETF market, and I think they're worried about that because banks still have systemic importance. They're worried about possible contagion effects from banks' activities to the banks themselves. It's important to point out that ETFs have become more transparent over the last 2 years. Many issuers have moved to daily publication of collateral baskets and swap exposures. We're starting to see securities lending collateral being disclosed. And I think investors are generally better informed of structural risks, especially in Europe. I think we need consistency in regulatory treatment, and clearly financial sector risks have risen across the board, and these go far beyond ETFs. With that, I'll turn to the question and answer session. Perhaps I could start with you, Eleanor. I think you need to unmute yourself. But what have been the key questions that your clients have been asking you in the risk debates this year?
Sure. I mean, one thing I'd like to say is that really the notion of a due diligence questionnaire or an RFP, one that we see very much on the institutional side of the business, having been the case for a long, long time, really has crept into the business on the ETF side as an ETF issuer really only in the last couple of years. So we have dedicated ETF questionnaires that we get. And that's usually a big indicator of how deep and focused the questions, especially on risk, are going. I think you touched on some of them already. The obvious ones are structure, securities lending, if it's a physical replication provider, swap. More recently, though, one that's crept in, which might be interesting for some of the listeners, is the number of APs and market makers that are participating for various ETF issuers. So that's a new one, and that's partly driven by the distinction of ETF providers in the European market. You do have what we call in the industry vertical ETF providers, as well as more sort of open architecture. So that's a more recent one that's crept into the market.
Okay, thank you, Eleanor. Bert, I want to ask you a question about UCITS, because this is obviously taking place in the context of a lot of regulatory discussions. Do you think that UCITS will still be able to use derivatives and lend securities in a couple of years' time from where we are now?
Well, I think
perhaps Bert, you could answer that. Eleanor, okay. Please add your comments in a sec.
I think that's a difficult question. I think there's definitely a risk that it will not be possible anymore to use derivatives and to do sec lending in the same way as it is being done today. I think there is definitely a kind of regulatory push to change use of derivatives and sec lending today. I think you can see that, you can feel that in the ESMA paper, and that was also displayed at the open hearing ESMA held in Paris, is that there clearly is a concern from regulators that certain strategies put into a UCITS wrapper at the moment are becoming too complex, and questions are being raised whether the UCITS format is the right format. And I think if you look at that, and at the same time you look at another regulatory framework that is being put together under AIFMD, so kind of regulatory framework for alternative investment funds, I think it is possible that there would be regulatory pressure to get certain strategies, complex strategies, out of the UCITS and into the AIFs. I think that risk exists.
Okay. And Mirzha, from your perspective, you obviously, your research institute concentrates on asset management across Europe as a whole, amongst many other subjects. I know you recently hosted a seminar involving regulators and issuers in Brussels. What were your major impressions, and where do you see ETFs fitting into the broader funds debate in Europe?
Well, we indeed had a quite interesting debate with the Bank of International Settlements, ESMA, and yeah, as you said, the three main providers. And I personally got two impressions. One is that it's starting to be a very polarized debate in the industry between physical and synthetic providers, with the physical blaming let's say the total return swaps, and on the other side, speaking about securities lending and the similarity of risks. So there's a real concern that falls within the shadow banking initiative of the Financial Stability Board and the G20, of looking at all these, let's say, prudential concerns regarding non-bank intermediaries, and this is the major, let's say, a prudential concern, a business model that involves bank funding through ETFs, but it's a warning at a very early stage in the product cycle. So there's still no risk per se. It's more the incentive and what they come forward. And okay. This would be my second conclusion. There's a bit of confusion between complexity for retail investors and what is a systemic risk concern.
Okay, Eleanor, can I come back to you and perhaps you could continue on those two thoughts from Bert and Mirzha, and I'd like to ask you specifically. Mirzha's mentioned some polarization of the debate. Given the risk concerns that regulators have raised, are there any types of? I know State Street uses physical replication for its fund, but I mean, talking more generally, are there any types of ETF that you, as a firm, would not issue, or even types of indices that you wouldn't choose to track, given the risk concerns that regulators have raised over the last year?
Yeah, certainly. I mean, so State Street Global Advisors, yeah, our SPDR ETFs are all physically replicated, as you mentioned, and certainly we don't think that swap or synthetic is in any way bad, and certainly they are UCITS regulated. I think that's the point here, and none, as far as I know, UCITS ETFs, that is, since they've launched, whether swap or physical, have actually failed. So I think that's an important point. So we've got a pretty, not a long track record, but a pretty good track record with some pretty eventful stress tests since 2000 when they launched. So I think that's an important point. I think in terms of when we launch or don't launch in terms of product development, I mean, regulation is probably the first and foremost consideration that we take. What I would also say, there's some practical implications, right? So where can you set up accounts? What's actually tradable? What I would say is, finally, the commercial aspect of it is usually the last consideration we have as a product provider. So in terms of, can you gather assets? Or is it just a nice idea, but nobody's actually interested in it? And then certainly, does the product then fit within our own SPDR ETF branding, i.e., what clients have come to expect of our products? Are we able to deliver? And what I would say is that oftentimes when there are gaps in the market, that's okay. There's probably a good reason for that. What I would say is, we at SPDR ETFs, we're an extension of State Street Global's advisors' physical investment management business. So we're not in the business of swaps and synthetics, but that's not to say that we would never look at that, but it's just that's not our core competency. That's not where we can add value.
So can I just ask you another question? So you're not against synthetics in principle, but you focus on physical funds because that's the nature of your business model.
Right, that's our core competency, where we manage physical assets mostly on a passive basis globally. So that's what we're known for. I think synthetic and swap, especially where those are UCITS regulated, there are regulations around that. And I think, unfortunately, a lot of the debate that's happened is very micro and is kind of missing a lot of the debate. I mean, I think vis-a-vis securities lending, that conversation in the U.S. is non-existent. So a lot of my colleagues are always astounded by the level of inquiry that we get on securities lending over here. And what I would say is, it's actually, from a physical ETF perspective, it's not core to the ETF. So take away securities lending, by the way, many of them don't participate in securities lending, the ETF still is in existence. So it's an ancillary business, and by the way, it is a well-established practice business. So it started in the mid-70s. So it started in the U.S., and then I think the first cross-border activity in securities lending happened in the late 80s. You're looking at $1.8 trillion that are on loan at the moment. 11.3 trillion are actually lendable. And you touched on this earlier, which I think is really important. So the ETFs are not the only participants in the securities lending environment. You've got central banks that participate, you've got sovereign wealth funds, pension funds, and the list goes on. So there are a lot of number of participants, and as you also mentioned, you know, that not all underlying securities are on loan at the same time. The indemnification piece we know to be one that is looked at pretty closely. That's one that SPDR ETFs offers in its securities lending program. It's a sort of second layer of protection. So I think there are a lot of things that are still misunderstood. But the great thing is this debate in Europe is pushing the entire industry to actually know what securities lending is, what counterparty risk is. It's really pushing investors to look really deep, not in just their ETF investments, but across all their investments. So that's the good news.
I mean, that's interesting to hear, and I think that's certainly the impression I've had over the last few months, because it doesn't make sense to look at this only in an ETF context. You have to look at it more broadly. But with that in mind, I mean, Bert and Mirzha, because I found the title of ESMA's paper a little bit confusing. Are they looking at ETFs? Are they looking at UCITS? Is this debate going to be widened to look at all funds? Are the regulators probably going to do ETFs first and deal with other UCITS-related things later? I don't really understand the thought process amongst the regulators. Could you let us know what you're thinking?
I think it's wider than ETFs. And I think that clearly the paper also showed they're thinking about structured funds also. So I think it's basically, if you want to generalize, it will be probably swap-based UCITS would probably be the topic they're looking at. So I definitely do not think it's only limited to ETFs.
So swap-based UCITS would be part of the ETF market, but also things like absolute return UCITS,
exactly,
structured UCITS, tracking other.
I think that's the message I got when I read through the paper, and that was also the message that was provided during the open hearing at ESMA. Is really like they're looking at swap-based structures more than looking at ETFs only.
Mirzha, how do you see this debate influencing the asset management industry or business as a whole over the next few years?
I think there are potential implications. As Bert pointed out before, since we have the AIFMD, the position of UCITS, I think, needs to be...
AIFMD is the Alternative Investment Fund Managers Directive.
Although the AIFMD applies to everything that is not UCITS, in essence, it provides, let's say, a general framework for the asset management industry that could encapsulate UCITS. And in this regard, we may well see that what now is UCITS become a sort of AIF. But the debate is, as I said before, double. There's on the one side the protection of retail investors, and ESMA is looking now, I understand also, although the consultation paper referred to ETFs, is looking at UCITS issues, for example, introducing limits to securities lending for all UCITS, making the rules that apply to collateral more stringent and apply it for all types of collateral that is pledged. And then there's the prudential side, and in this area, in 2012, the Financial Stability Board has set a task force to look at securities lending, reuse of collateral, and so on, in a broader perspective of financial markets. So there's more to come.
And I think the point on securities lending, I think, as Mirzha pointed out earlier on, it's not only a question about ESMA looking at it, it's also shadow banking concerns which have been leveled at the G20 and which are looked at by the Financial Stability Board. I think securities lending is also a point that they're looking at, and especially the possibilities to reinvest collateral provided on securities lending. And so there's also the shadow banking point, which we shouldn't forget, I think, in the whole debate.
Okay, I would like to turn. We've got a number of questions from participants. Thank you all for sending them in. I'd like to. A couple of them, perhaps Bert, I could ask you to answer this one. A couple of people have asked whether an unfunded or funded swap ETF is the more secure or flexible structure for the end investor. The other person who asked the question on that said, can you briefly explain again the distinction of which is more risky for the end investor? Bert, could you?
I'm not sure whether one or I'm not sure whether one or the other is more risky for the end investor. I think they're just different structures. And I think if we're talking about ETFs, the fact we're talking about synthetics or not, I'm not sure whether there's more risk involved. I think it's just more complex to explain to an investor how such an ETF works and how it is set up. So I think the whole debate is more one of complexity rather than risk.
But I've heard some people say that in an unfunded swap ETF, because the fund owns the assets which it then swaps for the index return, it's effectively more secure than a funded swap structure, because there it's just a pledge of collateral, and if the counterparty goes bust, the administrator could temporarily freeze the collateral, and you might have to wait to get access to it. Is that a fair point?
I think it depends on the type of collateral provided. You can perfectly provide for transfer of title collateral, for example, which put you in the same situation as the one you just described. And there are definitely ways possible. For example, if you make sure that the collateral provider is a financial collateral arrangement. For example, that would survive a stay in a scenario of administration, for example.
Okay, so you need to look at the details of how the collateral is held by the custodian.
Yes, I think that's important.
Eleanor, could you answer a question about counterparty risk? If someone has asked, if the ETF provider doesn't publish counterparty risk on its own website, where do you get the information? Eleanor, are you? I think I may have been muted.
Sorry, it wasn't allowing me to unmute. So if it's not published, the best thing always to do is call the providers. So I think it's fair to say most ETF providers, whether synthetic or physically replicated, absolutely want to make sure that it's still a very tiny industry, fast-growing, but certainly we, all of us, want to make sure that clients have the information that they need and are comfortable with that. So the best thing to do is call the issuer.
Okay, and another question for the same person: which banks have the largest exposure to ETF risk? I think not which ETFs has the largest exposure to bank risk. I don't know. How would anyone like to try and answer that one? I assume that means banks with ETF operations, I suppose, or synthetic ETF providers. We'll try and maybe we can try and get back to you on that one, Paul, who asked the question. Another question about index construction transparency. Maybe Eleanor, you could answer this one. According to the questioner, some index providers are fairly poor at providing access to the specific index methodologies, and do ETP providers have a fiduciary responsibility to provide these methodologies to investors?
Methodology versus constituents, I think, are two different points. I think the methodology is usually pretty well laid out by the index providers. I appreciate that, and I agree with the question that the providers are different. I think the methodology is important. What I will say is that that's where sometimes looking at the fund, so the ETF, and the holdings in the ETFs, that should usually give a pretty good indication. But the methodology, absolutely. So that information is usually well known.
Okay. And Robert Rush has asked a question: How is it better to have low quality? I think he's referring to Robert. You're referring to the slide I've put up, saying that it's better to have low quality collateral from a good counterparty than vice versa. And you're asking, in today's market, who is the good counterparty? Well, I think that's a very good question. Anyone have any thoughts on that? Counterparty risk in general has been rising.
One thing I can say is that in terms of the securities lending programs that are in some of our SPDR ETFs, that the counterparties that we had pre-2008 versus the counterparties that we have today hasn't changed that much. So there's some obvious names that have fallen off the radar for everybody, but the actual the list of counterparties that is certainly from State Street's perspective, that list hasn't changed, and that's an ongoing due diligence process where there are certain names in the market. Having said that, there's a much greater array of counterparties that, for example, the securities lending program participates in than, for example, some of the synthetic guys that are out there that are doing the multi swap programs. So I think that's a consideration. In terms of the type of quality, I agree with that question. Low quality versus high quality. What's quality when you're not able to identify or quantify in it? But that's certainly from State Street's perspective, the quality has gone up.
Oh, okay, thank you very much, Eleanor. I have an additional question for you and perhaps for the other panelists. A couple of people have brought up the recent MF Global case, which has obviously raised raised some concerns amongst investors that assets that they thought were, or cash, perhaps I should say, that they thought was in a client account ended up being used. Apparently, ended up being used by the failing firm. So, what steps, or what can an investor do, or what due diligence steps can he take to protect against mishandling of collateral, as in the MF Global situation? Bert, perhaps that's one for you to start with.
I think it links a bit to I think it links a bit to what I said early on about what type of collateral is providing. If you look in MF Global, I think that was also the case in Lehman Brothers. There's a question about clients' assets and how clients' assets are protected. And I think that's something that came forward in Lehman Brothers and has been followed up by the FSA in the UK. Is protection of clients' assets is key, and the FSA has changed its rule book on certain points and has also had a very forceful enforcement policy on that point. So I think it's a question about looking where clients' assets are, and also I think collateral, maybe just to make sure that investors know what kind of collateral they're providing, and if they're providing transfer of title collateral, that's exactly what it means. Is you transfer title to a party, and you end up with a mere contractual claim against that party.
But that brings, you mentioned the FSA there and FSA standards. With ETFs, we're obviously we have funds that may be domiciled in Dublin, Luxembourg, France, Germany, some other European countries. They may be listed in several different countries. Counterparties may be in different countries. Custodians may be in different countries. How do those questions then apply at a European level, if it's possible to answer that question?
But I think it's a difficult question in a sense, because there we're talking about, especially if you talk about ETFs and UCITS and funds, you talk about the depositor and the role of the depositor. And I think one of the points of AIFMD is especially looking at depositors' liability and depositors' liability regimes. And that is something which has been increased under AIFMD, and which will probably be replicated in UCITS 5 also, is to make sure that there are clear rules on segregation for depositories of funds, and that they are respected throughout the chain of sub-custodians.
Okay, and Bert, if I may, another question for you. I think this is certainly for securities finance lawyer. Ron Slivka has asked, in derivatives-based ETFs, is the documentation applies for collateral management under the credit support annex? But for physical ETFs, what well-developed documents procedures exist to mitigate risk on collateral deposits? Is it pledge agreements only?
That you probably have more tailor-made security arrangement, and I think, as I mentioned earlier, the transfer of title security is always something which is a very strong security arrangement, and which is something that could work in that framework. I don't see why it would only be pledge arrangements, but I think transfer of title is definitely something which is a security arrangement that will work.
Okay, thank you. Eleanor, question for you from a participant. If ESMA mandated that ETF providers all had to move to physical and outlawed synthetics, what impact do you think that would have, and how quick, could some of the providers switch, or perhaps could they, maybe I could add a question of my own, could they carry on running ETFs under a different regulatory regime, and would this even matter? I mean, would it be I know that would probably restrict access to retail investors, but given that ETFs are typically not held by retail investors in Europe, is that such a big deal at all if it happens?
I think it would. I think it would be a shame. I think more choice is better generally for investors than less. That's one point. I appreciate the sort of the retail piece of all of this. Having said all of this, if we looked at the United States, where ETFs began in 1993 with the SPDR S&P 500, what I can tell you is that where it's not a physically replicated physically replicated form, which is normally in the 1940s Act structure, which you sort of pointed out earlier in your presentation, they are in ETNs or note form, and that I would have thought would be the alternative. So I don't think it will be the death of other providers in terms of what they're able to do. I think there could be some providers in the market today who have some indexing capability. As I said, for some it's not their core competency, so their core competency is managing these types of synthetic or swap structures, which tend to be more complex, but they do have a purpose, and they can go. It's really important that investors realize that where physical, we live in the real world from a physical ETF provider perspective, so we can only go, so we have our own limitations, and so the synthetic and swap under UCITS, under a very tightly and well-respected and recognized brand, and more importantly, regulatory environment, can take investors into asset classes and markets that we as physical providers at SPDR ETFs, for example, can't go. So I think it would mean that it really puts a limitation on that. But having said that, there are other vehicles like an ETN that would be available.
Thank you very much, Eleanor. Mirzha, would you like to comment on that as well? I think you may have just muted yourself.
I think now I am unmuted. Sorry.
We can hear you.
I don't think ESMA is going to let's say prohibit the use of derivatives in ETFs at this stage, because as we said before, the ETF is just a part of UCITS, and if a big reform of this type will go under UCITS, it will require quite a long, let's say, process of thinking and then legislating. What may happen is that the requirements for collateral may be harder, and what ESMA can do at its, let's say, its competencies. What I think in the debate that we have now, and what we will discuss already and in the next months, is on MiFID. And in principle, the draft excludes a structured UCITS from execution only. In the recital, they in fact mention products that embed a derivative or are structured, although in the rule itself that has been proposed, they only mention structured. This is the definition in the key ID. We don't know exactly what falls into that, but first of all, they're going to address, let's say, selling procedures and marketing, and then they will think about what goes within UCITS.
So you're suggesting that MiFID may put some additional barriers in front of retail investors who might want to access some of these synthetic products, not just ETFs? It would just be some additional form of qualifications that people would have to...
Indeed, they will have to follow the suitability and appropriateness test. They will have to receive advice.
Okay. With that, I'm afraid we haven't had time to answer everybody's questions. I'd like to thank everybody for sending in some very interesting ones, and I'd also like to thank our three panelists for an excellent debate. It's been a very interesting webinar for me, and I'd like to thank you all attending and look forward to welcoming you at our Index Universe webinars in 2012. Bye-bye.